It's no surprise to anyone that has been keeping up with markets and economics as they have been playing out in 2021 that we are seeing rising prices in goods and services that we're buying. And indeed, this is reflected now in a higher CPI rate. The annual consumer price inflation index has reached about 5% year over year. And now there has become a dichotomy that has formed inside of investment and market analyst and economist. Essentially, there are two sides being played at right now. One side says that this is a temporary measure, that this CPI that is being bumped up is caused by certain special events that occurred during the pandemic, and as the economy reopens and returns back to normal, those pressures will ease and the price inflation will abate in the next few months. And that's namely the narrative that is coming forth by the Biden administration as well as federal officials. Jerome Powell and Janet Yellen are what I call the two hallmarks of this narrative. But then there's another narrative that has been coming out that has been, called out by market analysts, investors, and economists. Michael Burry, for one, who was made famous by the movie Big Short, when he, as a hedge fund manager, successfully predicted and bet that the housing market was going to crash in '07 and '08, and positioned his investments appropriately to benefit off of that crash and collapse by trading credit default swaps on mortgage-backed securities, as well as several others. So I have represented that narrative here by Jeffrey Gundlach and Steve Hanke. So this is back in January, and you can read the quotes for yourself by these people, but here, you've got a separation. One side says, well, we're not really worried about this inflation. This is going to be temporary. The other side says this can be a problem because it has certain ramifications in the economy. So in this video, I'm going to go over a way to sort of give you an outlook, a projection of what inflation is going to be like in the coming years based off the rate of the money supply growth that has been occurring ever since we have come out of the pandemic. So I'm going to do this monetarist style, which is represented by the school of thought of the Monetarist School of Economics, which Steve Hanke right here, who's an economist at Johns Hopkins University, he is part of. The monetarists were made famous when Milton Friedman, basically the monetarist founder, successfully predicted the inflation crisis of the 1970s. That was how he made his claim to fame. And the monetarists strictly believe that all price inflation has a monetary source, aka you print money, you're going to have an increase in prices as you devalue currency. It's very common sense oriented. And the monetarists tend to be right. So what I did was compose an aggregate compilation of the CPI and how much the CPI increased per decade, and then compared that to the increase in the money supply represented in column B as M2, as well as total debt. Okay, so in this case, I use total debt to sort of like give me a gauge of how much of that money is actually used and coming out into the economy through loan creation. And then I use the base amount of money increased as measured by M2. And what I found was something very interesting. I found that when you averaged those increases, there was a strict relationship between those increases and the CPI inflation index. And then there was a third factor that played into it, because although there was a relationship, it wasn't always direct and linear. It varied from time to time, and I call this the confidence in the US dollar. So aka if confidence in the US dollar is high, you could theoretically have more money printed and more debt created and not result in a higher price inflation, relatively speaking, because a lot of confidence has been placed in the dollar, so the dollar will be parked, those new dollars will be parked most likely in investments or in savings or some type of preserved wealth generation effect. instead of being used to buy consumer products, which would drive the consumer price index. So by decade, it's very interesting. So from 1959 to 1969, you had the CPI increase over the course of 10 years, 28%, which is an average inflation rate of 2.5%. And even though it increased by 28%, look at what money and debt increased. They increased by 100%. So money and debt doubled, yet the CPI only increased by 30%, or almost 30%. And so that told me that the confidence was relatively high. It was, about 72%, which all I do is I just take this average and subtract out the CPI inflation rate. And then 10 years later, you did have a higher growth rate in the money supply and debt. But look at the increase. Even though money supply and debt increased by about 35% more than it did during the previous 10 years, because this is actually this is an increase of 170%. So it was, the money supply and debt increased by a factor of 2.7 versus a factor of 2. So that's a 35% increase. Look at what happened to your inflation rate. Your inflation rate practically tripled here. So that told me that confidence in the US dollar was low. So essentially, inflationary forces can feed back on themselves, and people can panic and go through a flight to good scenario. And there can also be other extraneous events that happened out in the economy that could also push up these prices, and that can reflect in a higher CPI rate. And then for the next 20 years, you can see that confidence was higher in the US dollar, and indeed the inflation rates were lower, but it was not at the level of where it was in the 50s and 60s. So there was still this kind of hindsight going on, even in the 90s with the bull market rush. But then something interesting happened, and starting in the year 2000, confidence in the US dollar was largely returned. And it went back to that 1960s level where there was practically a 70% confidence rate in the dollar, and indeed that represented out in inflation of the CPI. And to me, that explains a large part of why we did not go through excessively high inflation after the 2008 crisis, despite heavy monetary stimulus. So what's happening now? Well, starting at the end of 2019, going into 2020, we went through a crash, obviously, from the pandemic and forced government shutdowns. And then look at what's happened. The Federal Reserve has printed a huge amount of money within the course of a year and a half. And yet the CPI has only inflated by about 4% since January of 2020. Okay? And so that tells me that confidence is really high in the US dollar by this average. And I think it's unusually high because we've never seen confidence get to this level before. And what I think is that we're seeing a delayed reaction to inflationary forces in the CPI. I think that this level will reach closer to the 70% confidence level as it has historically done in the last 20 years. And that's a conservative estimate of what inflation will be. And so what I have given to you is an inflation gauge of what to look at if inflation was to get back to this level of 70% by the end of this year in 2021, what this year-over-year inflation rate will be. And it's pointing to about a 7.5% or 8% inflation rate. Does this mean that we'll hit that inflation rate in 2021? No, not really. It could, definitely, but even if we don't and say we hit at 5 or 6% and just stay there, a lot of this will carry over into the next year, and it will be elevated rates of inflation until we get down to at least this confidence level of 70%. So I've color-coded this to tell you what the inflation rate would be based off of confidence in the US dollar. So if confidence in the US dollar starts to fall, then you can expect that the inflation rate will increase. So this 8% will go away and it will turn into 10. And if confidence falls almost to the 1970s level, it'll strike up to 13. And if we do get back to that 70s level falling confidence in the US dollar in a panic, a 1970s inflationary event, we could be looking at a 15% inflation rate by the end of this year, which would be absolutely catastrophic. Now, based off the increase in the money supply debt, I've decided to chart out the increase in M2 over the course of 10 years. And the way I have done this is I have taken the average of M2 growth after we have, you can see it down here, the average after we started coming out of the sharpest shutdowns and after the Fed printed a huge amount of money stimulus to shore up liquidity in the banking system. So, but ever since then, the Fed has been having their foot on the gas pedal, so to say, and they have been printing money. They have been buying $120 billion of mortgage-backed securities and U.S. Treasuries every single month, and this is having an elevated increase in the money supply. And so, if debt increases as it has been doing for the last year and a half, and the money supply increases as the rate that it has been going ever since we've come out of the pandemic shutdowns, then we're at least looking at a 4.5% inflation year over year for the next 10 years. And, the CPI will increase by about 60%. That's if confidence in the US dollar remains high. If confidence starts to shake and we start seeing a flight to good scenario, we can easily see 9% inflation. And if the Fed does not take their foot off the gas, that can become a real painful reality. Needless to say, this has certain ramifications, but the biggest one is that the poor and the elderly will suffer greatly from this decrease and diminishment in wealth, which is one of the reasons why I've created this channel, is sort of to give an alert to everybody that we're going through an unprecedented time here. And despite the narrative that is coming out of the official administration right now, price inflation's here to stay so long as the Fed keeps their foot on the gas. Now, the minute that the Fed takes their foot off the gas and stops all the money printing, then yes, we will see these price inflation forecasts start to drop a little bit and hopefully stabilize. And if we can reach a point where it stabilizes at an acceptable level to where investors do not abandon their investments in stock and keeps confidence in the US dollar high, no matter what economic troubles we come through because the Fed had decided to stop, overshooting the liquidity into the banks, we'll be able to recover. But when we have an inflation crisis, that's much more difficult to recover, and it takes a longer time period to recover from that, as evidenced by the early 1980s, when Paul Volcker had to jack up interest rates from 5 to 10% to 10 to 15 to 20%. The real problem comes into this is that, unlike back in the 1970s, our debt as a percentage of our economy has exploded in the last 40 years. So in the 1970s, debt to GDP, total debt, meaning all government debt, all private debt, was about 150% of 1 year's gross domestic product. It's now at 400%. So it's 2.5 times larger than what it was 40 years ago. So any rise in interest rates will increase debt cost and debt burdens on our businesses, on our workers, on our government, on our people, and on the masses and the populace, far greater than what would have happened in times past, and that could be absolutely disastrous to our economy. So I leave you with this kind of warning that if this inflation measures start to stay, we may need to reach a point to where we start paying down our debt very quickly. And to shore up whatever savings that we can get, and to purchase hard assets to retain and regenerate our wealth, or preserve our wealth until this storm blows over. And ultimately it will blow over when political forces coming from the people demand a greater change out of our government, a more fiscally responsible government that is based off balanced budgets, restricted conservative spending, and a much more tame, reserved Federal Reserve instead of this activist Federal Reserve that we have now in our economy. It needs to go back to being passive. So anyway, I thank you for watching this vid. If you can, just click a like on it and subscribe if you like my content. I'll try to post more often these days as we are about to enter unprecedented times.